Well, accrued rent of the accrued rent was how much? How much was our accrued rent? I hope we have our question also and we are looking at it. How much is our
210,000.
210? And then how much was the prepaid insurance?
880,000.
180. So how are we going to treat it? What we will do, that the fact that the rent is accrued means that we have already spent this rent in this financial year of 2019, but we haven't paid for it. So from the 6.2 thousand, so what it's going to be, it's going to be the 6.6 thousand. Okay, 6.6. We are going to add an extra 210 because it's money that we have already spent, but we have not, it's money that we've already spent, but we've not yet actually paid for. So it's rent that they are demanding us. So it will increase our expense. Accrued rents, an accrued expense increases the current, increases the current expense that you have, and a prepaid rent and a prepaid expense reduces the current expense that you have. So our accrual, we are going to add it back to increase to actually get the total rent that we should be paying for the year of 2019. And then for the prepaid, because it doesn't relate to the year 2019, we are going to remove it. So we're going to subtract our prepaid rent, our prepaid insurance. And the answer that we get is going to be our net rent and insurance. So that will be how we calculate that. So when we go back to our answer, how much is it going to be? Our 6.6 plus the 210 minus the 880. How much is going to be our net rent and insurance? How much is going to be the net rent and insurance? $5,952,000. Yes, thank you. So we move forward. We have gotten now, we have cleared rent, we have cleared the drawings. The drawings are not going to, they're not expensive. Drawings affect retained earnings. So we will make that entry when the time comes. We have postage and stationery. Do we have any note on postage and stationery? There seems to be no adjustment, so we're going to carry it straight. How much is it? It's 3,001. So I'm going to get my postage and stationery, put it there. Okay, going next. The next line is advertising. Do we have any advertising? Of course, it's an expense. Do we have any adjustments that we need to make on advertising? There seems to be no adjustment, so I'll also just take it straight to my P&L. And then they also told us the next line, we have salaries and wages, which are 26,420. Do we have any adjustment on salaries and wages? No, we do not. So straightforward. Some of the good thing with this reporting question, there are some entries that are straightforward, and so you just copy and paste. And the fact that they mark entries in accounting, it's not good to just give up on a question just because sometimes you just have to try and just carry the things, and you hope that you've carried the right. You just copy and paste, and you hope that you've copied the right things. The next line after that, after salaries and wages, we have our irrecoverable debts, which are 877. Irrecoverable debts, we say that is going to be, it's going to reduce our profit. It's going to reduce the money that we thought we're supposed to get. So we'll expense them. We'll write that money out of our P&L by expensing that portion of by expensing the recoverable debts. And so that will also be straightforward. And then next, they told us we have allowance for receivables. We have 130. But then when we come back here to the notes, they're telling us that the allowance for receivables is to be increased by 40,000. So that means that, yes, at first we had allowed for 130, but it seems that maybe it's likely that more people will not be able to pay also in this period. So what that means that we have increased our allowance from 130 to now 170. But the fact that the 130 is already existing in the, it's already there. We had already accounted for it. But now they're telling us that the allowance for receivable increased by 40,000. So that means that even the profit is going to have to reduce by that 40,000. So we're going to come and expense the 40,000, and we'll call that our increase in allowance for receivable. If it had reduced by 40,000, then it would be an income. If they told us that allowance reduced by 40,000, means that we would reduce this 130. Okay, this 130 by 40, and that means that we'll add back that 40,000 back into our income. But now the fact that the allowance is increasing means that we are anticipating that very many more people will not be able to pay, and that means that we are anticipating that our profit is going to reduce. Our income has reduced. So moving on, we have receivables. These are not expenses. Payables are not expenses. Cash on hand, this is not an expense. Cash at bank, not an expense. Inventory is not an expense. Equipment at cost, the equipment in itself is not an expense, but we need to depreciate the equipment. So we're going to come and see what they told us about this equipment. Equipment is to be depreciated at 15% per annum using straight line. So that is very, very easy. What we will do, we'll just get our 15%. It's straightforward. Well, the moment you see the word straight line, it makes it very easy for you. You just get your 15% times the cost. The answer is 870. So the depreciation, that means that every single year the depreciation is 870. And so we shall come and expense the 870. So when we add that up, how much are our operating expenses? What is the total of our operating expenses?
Excuse me.
Yes, please.
I'm sorry to take you back.
It's fine.
Okay, I thought increase in allowance for the receivables. I thought we would add it to the 130. So we just record the 40.
Yes, we record the 40, not the 130, because the 130 is already recorded in the previous years. It's already there.
Okay. Thank you.
Yes. So how much are our operating expenses? Please, let's do the math. How much are our operating expenses? $49,223. Thank you, Esther. So get our operating expenses being that. So for us to get either our net profit or loss, what are we going to do? We're going to get our gross profit, which is 55,000, and we're going to subtract it. We're going to subtract the 49.2. When we subtract, it gives us a positive of 5,918, meaning that we actually made a profit. And so this is Mukisa's P&L for the year 2019. The question, sorry, for the year 2020, ended May 2020. So the question went ahead and asked us to also calculate the financial position. So we are going to do Mukisa's balance sheet. Basically, that is what a statement of financial position requires us to do. Of course, as usual, we shall start with our heading, Muviru Enterprises. Sorry, not Mukisa. We'll have Muviru Enterprises, the name of the business. Muviru Enterprises. Muviru Enterprises, statement of financial position. As at May 31st, 2020. So like I told you, whenever in doubt, always just refer back to the question and see whether you're using as at or for until you're very comfortable with it. So our statement of financial position, we know that it always starts with assets and organize them in the order of liquidity. So we'll start with our assets after putting our levels of precision. We'll start with our assets. We'll start with our non-current assets in order of liquidity. The hardest to liquidate is the one that you put first. So we go back to Muviru's TB and find out what assets he has, what non-current assets he has. We've already dealt with these, so I'm just going to go straight to our non-current assets. I saw he has equipment at cost, which is 58,000. So I'm going to show that Muviru has his equipment which cost him 58,000. And we've also already depreciated Muviru's equipment. We know that it depreciates by 8,700 every single year. So what are we going to do? We need to find his net book value. For us to find the net book value, we know that net book value is equal to cost minus accumulated depreciation. Here we already have a cost. We now just need to find the accumulated depreciation, but they've already given us accumulated depreciation in the question. So we already have our 19,000, and now we need to add the depreciation for this year, this current year that has just ended, which is the 8,700. 8,700. And that will give us an accumulated depreciation of 27,700. So when we get now that we have the accumulated depreciation, for us to get the net book value, we shall get our cost minus the 27,000, giving us a net book value of 30,300. And so we shall make those entries, show our accumulated depreciation, and also show our net book value. This question is quite summarized. So Muviru, that is all he has for profit for assets, for non-current assets, and we shall clearly show the total of his non-current assets. Moving on, we shall get his current assets. Once again, we organize in the order of liquidity. So we have, like we've seen there in the question, we've already taken care of most of these things, recoverable debts, but we have receivables, we have inventory, first and foremost. I know that inventory, Muviru has closing inventory somewhere. And I told you the balance sheet records closing balances. So why we take the closing inventory, not the opening inventory, is that the statement of financial position records strictly closing balances. So I'm going to get my inventory value as at the end of the period. The inventory was 13.5. And I'm going to come and write that in my statement of financial position, inventory being worth 13.5. Next, what other current asset do we have? What other current asset do we have for Muviru? In order of liquidity, we have receivables, which are worth 12,000. I'm going to come and write my receivables. my trade receivables that are 12.1 thousand. But now they also remember when we were looking at allowance for bad debts, we were told that in the statement of our financial position, we record the net receivables. And for us to get the net receivables, we'll get the total value of receivables and remove any kind of allowance, whether it's specific or general allowance. In this question, they didn't give us specific or general allowance, but rather we saw that there was an allowance that increased. The question told us that that trade allowance for receivables is to be increased by 40,000. So that means that the receivables are going to once again reduce. That means that the net receivables will reduce by that 40,000. So for us to get that total net receivables, we are going to get the 130 that we have. So we're going to get the receivables. For us to get, we need to be able to record net receivables. Net receivables equals total receivables excuse my English, total receivables minus specific plus general allowance for bad debts. So that's usually the formula. But now, while we have our net receivable, we have our total receivables being 12,120 minus the allowance that I had, which was brought forward, which was 130, plus now the increase in allowance, which is the 140. So we have to remove 170 from our allowances to get the net receivables. We will show that in our statement of financial position that we are subtracting our allowances for doubtful debts, the original one that we had, the 130, plus the increase. So that means that the new allowance for bad debts will be 170. So when you subtract 12.1 minus 170, we are able to get our net of 11,950. We also have in the assets, let's see, we have cash on hand, cash at bank. This, we also have insurance here, which has a prepaid expense. I'm organizing them in order of liquidity. So I'm going to get my prepayment, which was insurance, and I'm also going to add it to my current assets. And then of course, my cash at bank. How much is my cash at bank? My cash at bank is 1,001. Is this figure correct? We're going to first put a star here. This figure doesn't look like it's correct. But if I'm going to put it, first going to let it be blank. The cash at bank you're seeing is written as 1,000. It doesn't have the right comma, so that means that the question may have an error. I'm going to show you how we are going to solve that. But you will probably not have a situation like this in the question paper, because in the event that there is an error, you will be notified in time. But I'm going to improvise. So we have cash on hand, which is 177. We're going to show our cash on hand as 177. So when we add up all the items that we have, when we add up our current assets, it's going to be, our current assets are going to be inventory plus the net receivables plus the prepayments plus the cash on hand. I have not added the cash on bank. We will use it, we will look at it later, we'll look at it last, because we are not sure. We're not sure. I'm not sure. I don't think this 10,000 is correct. This figure here, it's not right. The commas are not placed, are not well placed. So I'm going to have to improvise. So just keep that in mind. So when we add that up, we are going to get our 56.8 million. Now we move on and get our liabilities and capital. So our capital, how much was our capital? I saw capital here. It was 53 million. I'm going to come and show my 53 million. Capital as at 1st June was 53 million. We also had our profit. Whenever we make a profit, it's going to increase, basically it's going to increase our capital and liabilities. So we carry forward this 59, add it to our liabilities, our net profit being that 55.9. And then we get, in case we made a loss, it would reduce our capital, so it would be a negative. We'll go back to the question. What else is going to affect equity? What else do you think is going to affect equity looking at this question? What else do we add? What else do we add for equity or liabilities? What else do we see here? What else do we see? Drawings. Yes, thank you. So we are going to add our drawings. We're going to add our drawings. Our drawings reduce the capital. So even if you're there and you're sole trader and you're removing money from the business, please know that you're eating your capital. Like this person made a profit of, or net profit of 5.9, but they withdrew 7.8. So you see that they clearly ate some of this 53 million. So when we add that up, our capital that we're going to carry forward is going to be 51.2 million. And then thereafter we get our liabilities. We start, of course, with an non-current liability. Does he have any loan of any kind or any kind of non-liability in the question? I don't see any. I personally don't see any, but in case you see, let me know. Non-current liability, but in case he had a non-current liability, for example, a bank loan, it would show here. So we go to current liabilities. I know he has accrued rent, so we will add that, but because we are moving in order of liquidity, I'm going to first get my, first going to go back to the question. I know that he has payables that he needs to pay, which is 6.4 million. I'm going to get my trade payables. And then I know he has accrued rent. That one I know it by head now. He has accrued rent of 210 million. So when we move on, does he have any other liability? Do you see any other liability that he's supposed to be having? No. Okay. Thank you for that piece. So in case maybe he had like a bank overdraft, it would reflect here. So we add up our current liabilities. When we add 6.4 plus 2.1, how much is that going to be? 6.6 million. Yes, thank you, L. Allen. 6.6 million. So when we balance off that current liability plus capital, how much is that going to be? When we add our 51.2 plus the 6.6, how much does that give us? Oh, the answer is yes, 57. So our total capital and liability is 57.8 million. Now, I need us to first look at something here. Like, remember I told you this question may not have a right answer. So ideally, it's not balancing. Here we have 56, okay? And here we have, for the total assets, we have 56. For the total liabilities, we have 57. Now, for what I'm sure, the liabilities, we have put them all. So I'm going to make this question balance. How am I going to make it balance? Remember, I told you the figure for cash at bank in the question is showing that it's 10002. The question is showing me that it's 10 million. The question was showing that there is 10 million cash at bank. So if I'm to add up that 10 million, the question would still not balance. Like I told you, by virtue of how it looks, you yourselves in the question paper, that will probably not be an issue, because in case there is an error, it will be rectified immediately. This question had an error. So I told you I was improvising. So I'm not going to use this 10 million. It's not the right answer. So what I'm going to do, let me just get a side note here. I'm going to get, just give me a quick second. I'm going to get what is the figure that's not making it balance. This 56 minus the 57 here. How much is that? It's 1032. And so now my question is balancing 57.8 and 57.8. So why did I not correct the question from the beginning? Because I knew it has an error. So why did I not correct it from the beginning? What I'm trying to show you is that with balancing, ideally your assets are supposed to be equal to your liabilities. If all your entries all the way from the start are correct, then the balance, this is like a check figure. This is like a check, which is what is going to tell you that everything else you've done is correct. If you do a question and it balances in your financial position, then you know that you have done very, very correct things. But please do not kill yourself in exam question just because you want to balance these things. At the end of the day, they mark entries. But how do you know what is causing your balance sheet not to actually balance? What you do, you get your assets minus liabilities, and whatever figure side you're sure is most correct. If let's say you're very, very, very 100% sure of your assets, that means that the problem is probably in the liabilities. And so you'll go back to the question and check the liabilities. If you're very, very sure your liabilities are okay, and the difference, that means that the difference may be coming from the assets. And so you go back and check your assets and find where the problem is. So that is just a trick I wanted to show you. You subtract your assets minus your liabilities, and whatever the difference is should be the reason why your figures are not balancing. And so it's up to you to reduce that difference by making the right entries. Do we have any question on this? Okay. Have we understood the concept of this, or do we attempt another question? Drawings are money that you pick from the business for personal use. It's not money that you use for business sake. So you find someone, you have your own business, maybe you're selling a matoke, and you pick, it's not an expense. It reduces your capital because you're using it for personal use. So there's no way you can masquerade it as an expense. And even if it's your own business, please don't record wrong things and lie to yourself that you made an expense of drawings. Drawings reduce capital, and that's just about it. So we're going to attempt another question. Let me share my screen and we can get started.
I want to add.
Yes, please. Yes, please.
For me, always when I see drawings, if they say cash drawings, I always debit drawings if they due cash, thinking that that drawings is an expense.
No, it's not an expense.
It is a liability.
You will debit liability and you will credit cash, because cash is reducing by crediting and liability is reducing by you debiting it.
Okay, I've done it.
So for the next question, we are going to use the notes that we have. Let's open them. Let's open the notes. For this other question, I know we've been using an exam type of question. The next one, we're going to use our notes. We're going to use a question in the notes. Let me know once you see my screen. Let me know if you can see my screen.
And you see,
Okay. We have our notes. Let me open my notes just a bit. Give me a second. Do you see the notes? Do you see my notes on my screen?
it needs to be adjusted. It's okay.
Okay, thank you. We should have a question about Sejusa in these notes. This is Mobiru. This is a bit easy. We've actually just looked at Mobiru, so that's okay. You take time and attempt Mukasa. This is Matovu. We'll be doing 15.6, that is Sejusa Patrick. They've told us you've been provided with the following trial balance as at 31st May 2014 for Sejusa Patrick. We have bank 150, inventory 3.6, general expenses 1.8. We have electricity, marketing and advertising, salaries, buildings at cost, motor vehicles at cost, plant and equipment at cost, accumulated profits, trade receivables, purchases, loan interest paid. Then we have 5% loan. We have revenue, we have discount received, we have trade payables, we have capital, we have accumulated depreciation for buildings, for motor vehicles, and plant and equipment. They are telling us that the following notes are also relevant. Inventory at 31st May 2013 was valued at 2.4. This is, we need to be careful about the period. Marketing and advertising include 18 million paid in advance for marketing campaign scheduled to begin in June 2014. There were salaries outstanding of 30 million for the year ended. Depreciation is to be provided for as follows. Buildings at 5% per annum on their original cost. Motor vehicles 25 per annum of their written down value. When you see something like this, this is just like the other I told you. Motor vehicles 25% per annum of their written down value. That's just basically telling you you're using reducing balance, because you get to 25% multiplied by the net book value. Plant and machinery 20% per annum of their written down value. They have told us prepare a Sejusa statement of profit or loss and other comprehensive income for the year ended 31st May 2014. And they prepare a Sejusa statement of financial position as of 31st May 2014. So let's get started. Please, can you see Esther, is this bad? Can you see, or is it not okay?
It's actually okay. My thing was for the ones when they were still small, but this one is okay.
Okay. So let's get started. We are going to, of course, let me close this. We're going to, of course, come up with our title. Like you can see, I already have my title there. Sejusa, statement of profit or loss and other comprehensive income for the year ended 31st May 2014. I'm going to go ahead and put my denomination, that is if the money is in shillings or not, and the level of precision. So we now know the formula by now. We know the format. We just move by the format. Question told us, when we go back to the question, I hope, are you seeing my Excel as well?
No,
Yes.
you're not.
No, okay, you've just removed it. Yes, we can see it now.
Okay. So they're telling us to get the profit or loss. We're going to, of course, get our sales. Remember, I told you when you see the word revenue, you know that is also sales. Sales can also be called revenue or sales revenue. Sales revenue or revenue is 17.6 million. So we're going to come to our statement and put that 17.6 million. being our revenue. And then we'll get our cost of sales. Get our cost of sales. I increase the font for you. So our cost of sales is going to be our opening stock. How much is our opening stock? They told us, I saw here in the notes, this year is for the year ended 31st May 2014. That means that it started on 1st April 2013. Okay, so inventory as at 31st 2013. Sorry. If it started on May 31st, balance as of 30, if it's ending on 31st May, ideally should be starting on 1st June 2013. So the year started on 1st June 2013. This inventory is showing us that this is a 2.4. I need to be sure which one is closing and which one is opening. Or if the question has an error. If that inventory is 31st May was valid at 2.4. We need to find the opening inventory. If that was June, this is it, 3.6 2013. So opening inventory was 3.6 million. And then we go ahead and add our purchases. We add purchases. How much are our purchases if we have to go back to the question? Oh, our purchases are here 6.6 million. So we add our 6.6 million. Do we have returns? Do we have any kind of business like that? We're working in thousands, yes. Unless we say, because you see already here, this is a summary of the thousands. So unless we summarize our question to a million, we summarize them by millions. Already so it's supposed to be 3.6 it's supposed to be 3.6 billion. So we're cutting it down to millions. So we have our purchases being 6.6. Do we have anything like carriage inwards and whatnot? When we go back to the question, just to be sure that we are not leaving anything out. I don't think we have anything like carriage inwards or returns and something, anything like that. So it's straightforward. I'm going to get my closing stock. My closing stock will be closing stock should be 2.4 billion. So that should be 2.4 million. I'm going to come and show here my closing stock. So how much do you think our cost of sales is going to be? 3.6 million plus 6.6 minus 2.4. How much should that be? How much is our cost of sales? $7.8 million. Okay, thank you. Going to be 7.8. So our gross profit.
Excuse me, madam.
Yes, please.
I was here wondering if inventory on 1st June was 3.6. And then in the notes, a day before, the inventory was valued at 2.4 billion. What could have been the reason what are the possible reasons for that decrease?
Why it opened as high, why it opened at 3.6 and it closed at 2.4?
Yeah.
It means that they sold some of that stock. Yes, because if you open and you have let's say you have 3.6 million kgs of beans and you close when you have 2.4, it means that people have bought those 12, a difference between the 3.6 and the 2.4, which should be about 1.2. means that people have bought it, so it's among the cost of sales. So when we calculate and we get, when we calculate the 17.6 minus the 7.8, we'll get our gross profit being 9.8. Okay, we add any other revenues in case they are there. Let's go back to the question and see. We have this. Let's go back we're going to go back to the top because you just keep on going back to the top and seeing what goes where. Bank, electricity, these are expenses, salaries, buildings, trade receivables, purchases, loan interest paid, loan revenue. They're telling us that we have a discount received. So that means that we have an extra revenue that we might have received. Remember we said the discounts received increase our income. So we're going to come and increase our income statement by the 450. So we're going to add our 450 to our gross profit. It will be called other revenues. Other revenues, we have our discount received. So when we add this 450 plus the 9.8, we should be able to get our total revenue, our total income, our gross income of 10.2 million. So this is all the gross income that we have. And thereafter, we now remove any operating expenses. So going back to the question, what are the operating expenses that we may have? Bank, we know this is a balance statement of financial position item. Inventory, we have dealt with the general expenses. We have 1.8 of general expenses. So let's go to the notes and see if there is anything affecting general expenses. I believe not. So that's an easy mark for us. We carry it straight. General expenses 1.8. So you're not allowed to write on the question paper, but you could just mentally be ticking so that you avoid skipping or repetition of entries. We have looked at general expenses. Electricity, we have electricity worth 270. Do we have any note on electricity? No, we do not. So I'm going to get my 270 straight and add it, get my free mark. Move on to the next expense. Marketing and advertising, which is 744. Do we have any notes on that? Yes, we do. Marketing and advertising include 18 million paid in advance for marketing campaign scheduled in June 2014. The year ends on 31st May 2013. That means that it's prepaid. So out of this 744 million, we're going to remove the 18 million from the 744 for us to be able to get the net marketing and advertising expenses for the year 2013. So I'll come to my notes. I'll come and show that I'm making a note. Please remember to always show notes. In the previous question, I was not clearly writing for you all those side notes, but in the examination, it's important to show the examiner in case there is any adjustment to the figure in case there's any adjustment that you have to make to a figure, you don't just do it in your head. You clearly show that you made an adjustment and you show how you got that adjustment. So I'll make my note 1, which is going to be marketing and advertisement. I'm going to come to my notes, my other page that has my notes. And I'm going to get my marketing and advertising expense. So we know that marketing and advertising, they showed us in the TB that we had a balance of 744. But we have a prepaid expense out of that 744 million being 18 million. So when we subtract the 18 million from the 744, we'll get our net expense being 726,000. So the 726 is the net expense paid for the year ended May 2013, and it's going to be what we are going to put. It's going to be what we are going to put in our income statement. So I'm going to go down to my income statement and I'm going to show my 726. So moving on, the next expense is we have looked at advertising and marketing. Salaries, we have 1.7. We check our notes. Do we have any adjustment to the salaries? Yes. There were salaries outstanding of 30 million for the year ended 31st May 2014. So it means that inclusive of the in addition to this 14 million, is it 14? In addition to this 1.4, okay, in addition to this 1.4 billion, we also have an extra 30 million that we didn't pay. So we are going to add it back. Remember I told you accruals, add, prepayments, subtract. So we're going to go to our notes and also show how we get our total salaries, total salary expense. So I'm going to show my note 2 being salaries, get my expense, which is 1.4 billion. And I show that I also have accrued salaries of 30 million. So when I add that up, it's going to give me a total expense of 1.5 million for salaries. And this will be the total expense for salaries that I'm going to include in my P&L. Yes, Esther.
Rita, just for clarity, is this profit and loss account for 2014 or 2013?
It's for it's the year starts on 1st
Mhm.
June 2012. Let me just check the question. And it ends in 2013. Sorry, it starts in 2013 and ends in 2014. Because they're telling us that the TB provided ended 31st May 2014. That means that the year started on 1st June 2013.
Okay.
Yes.
Because it's a midway thing, so it was kind of I was confused at some points.
It's okay. So moving on, we have buildings at cost. The moment I see these assets, I know that I'm going to depreciate. So I usually want to do depreciation last. Let me check if there are any other expenses before I come back to depreciation. So this is depreciation. Every time you see an asset, just know that you have to depreciate, except if the asset is land. Accumulated profit, this is not an expense. Trade receivable, not an expense. Purchases, no. Loan interest paid, we have a finance cost of 90,000. So I know I'm going to have to add the finance cost of 90,000. I'm going to go back to my Excel and add my loan interest of 90,000. Thereafter, let me see if I have any other expense. This is a full loan, this is revenue, this is sales. Discount, this is an income. Trade payable affects the F&P. Capital, this is not going to affect. Accumulated depreciation, not for the P&L. Buildings, these are accumulated depreciation. So now I can depreciate in peace. I've been told they have depreciation rates here. 5% for buildings per annum at their original cost. Automatically, I know this is going to just be a straight line. So I'm going to get 5% for the depreciation for the building. I'm going to get 5% times the cost of the building, because I've told you building depreciation is to be provided for as follows. Building 5% per annum on their original cost. So it's going to be 5% times the cost of the building, which is 15 million. And so I'll come to my worksheet and I'm going to, come to my worksheet and I'm going to show my depreciation. For buildings, I'll come to my working. The cost of the building is 15 million. The depreciation charge is going to be 15% or it's going to be 15% of 15 million. How much is that going to be? Sorry, it's going to be 5% of 15 million. How much is 5% of 15 million? How much is 5% of 15 million? 750. Thank you, Alan. So I'm going to get my 750 as my depreciation charge. And I should be able to, for me to be able to get the carrying amount, I will get my 15 minus the 750. But because right now I'm just doing my P&L, I'm only interested in the depreciation charge. So I'll carry my 750 and add it to my P&L. So next, what was the next item that we had to depreciate? We have finished buildings, we have motor vehicles. Motor vehicles cost us 480,000. They told us we are depreciating motor vehicles at 20%, 25% of their written down value. So I'll again come to my notes and my side sheet and calculate. Calculate my motor vehicles. The cost of the motor vehicle is 480. Now I need to get the written down value. For me to get the written down value, I need to get the accumulated depreciation. So I need to go back to the question and see if it was given to me. Because we are depreciating off the net book value. When you see the word written down value, it just means the carrying amount stroke the net book value. So accumulated depreciation for the vehicles brought forward before we depreciate for the year, because they're telling, so what this is trying to say is before you depreciate for the year, you first have to get the written down value, and then you can multiply that by the 25% to get the depreciation charge for the current year. So I'm going to get my accumulated depreciation brought forward. Like here you can see 1st June 2013. That means that when the year was opening, these were the depreciation balances brought forward. So 180 for the motor vehicle. I'm going to show my carried forward accumulated depreciation, which is 180. And so that means that my written down value is 480 minus 180,000, giving me a written down value of 300,000. So for me to get the depreciation charge, I'm going to get 25% of 300,000. How much is 25% of 300,000? 25% of 300,000? Please, we have to try to endeavor to come with calculators for their question, for the class. Thank you, Alan. 750,000. So I'm going to put my 75,000 there. So my depreciation charge for motor vehicles is going to be 75,000. So I'll come back to my P&L and add that 75,000. Okay, thank you. So moving on, we have another item that was an asset, plant and equipment, also 20% per annum of their written down value. Just like how we've treated motor vehicles, is how we're going to treat our plant and equipment. So I'll clearly indicate here my plant and equipment. It cost me 2.1 million. We're depreciating it at 20%. Let's keep that in mind. I'll get the accumulated depreciation. How much is accumulated depreciation? Carried forward, it's 720. So for me to get the written down value, I'll get my cost minus accumulated depreciation, which should be the 1.38 million. So the depreciation charge is going to be 20% of 1.38 million. How much is that going to be? How much is going to be the depreciation charge? %of 1,380,000. 276,000. Yes, 276,000. So the depreciation charge for plant and equipment for the year is going to be 276,000. So we take that to the P&L as well. our plant and equipment is going to be 276,000. So I believe that should be it for the expenses. When we add them up, 1.8, 270 plus 726. How much do we get? How much are our total operating expenses? We're adding up this, we're adding up these. How much is that going to be? $5,487,000. Okay, 5,487,000. Thank you for that. Yes, please. Okay, so when we get our gross income and offset it against the operating expenses, we should be able to get our net profit of 4.7 million. That means that this 4.7 million, we shall be carried forward to our retained earnings when we are doing our balance sheet. So this is how our P&L is going to look like. The question went ahead and asked us, let's go back to the question. It went ahead and asked us to prepare Sejusa statement of financial position. So I'm going to come and prepare Sejusa statement of financial position. As usual, I'll start with my heading, my currency in which I'm writing the report, and the levels of precision in case any. We know by now our format, how it goes. We start with our assets and we start with our non-current assets and other assets. Order of liquidity. So we'll go back to our question and see what the assets are listed at as in terms of cost. We have buildings, motor vehicles, plant and equipment. Buildings cost us 15 million. Motor vehicles, so we're going to get our buildings at cost and show they cost us 15 million. So we'll write our buildings, the cost, which is 15 million. So now we need to for the assets, according to IAS 1, they need to be recorded at their net book value in the statement of financial position. So of course you will show the cost, you will show the accumulated depreciation, and you will show their net book value. That's why I have a PPE schedule here. At this level, this is how summarized it looks. But as we continue and further our studies, we'll break it down further, but that's not your problem for now. So this is how it will look. We have our cost, our accumulated depreciation, and our net book value. So we need to find the accumulated depreciation for the buildings. I'm just going to go back to my working here because we already had something to start with. We had our buildings, which cost us 15 million, and we had the depreciation charge for the year being 5%, which was 750. So what I'm going to do, for me to get the accumulated depreciation, I'll get the depreciation for the previous year, depreciation for the previous year plus the depreciation charge for the current year. So I'll get the accumulated depreciation plus the depreciation charge for the current year. So accumulated depreciation for the buildings was 6 million. So what I will do for me to get the total accumulated depreciation, it will be that 6 million. It will be the 6 million plus this 750,000, which should give me 6.7 million worth of accumulated depreciation. And so sorry, it's 6.7 million. So I'll come and show my accumulated depreciation there. And for me to get, of course, we know by now, for me to get my net book value, I'll get my cost minus the accumulated depreciation. Cost minus accumulated depreciation, which is 15 minus 6.7, it will be equals to 8.2. I'll go to the next asset. My next asset was motor vehicles. Same story, I'll get my motor vehicle. The cost of the motor vehicle, which was 480. The accumulated depreciation charge for the year plus accumulated depreciation brought forward. Yes, please. Okay, yeah, you just pay attention for this second part. It's the same way I got the accumulated depreciation for the buildings. So for the motor vehicles, we have accumulated depreciation brought forward for the year, brought forward from the previous years. It's 180. So for me to find the accumulated depreciation carried forward, the one that I'm going to carry forward for the next period, I'll get my accumulated depreciation brought forward plus a depreciation charge for the year. So here for the motor vehicles, I have accumulated depreciation, which is 180,000. So for me to get the new or the accumulated depreciation brought forward, I will get I'll get my accumulated depreciation brought forward. That was the one that was given in the question, and the depreciation charge for the year, which will give me 255. So this should be my accumulated depreciation carried forward, and it's what I'm going to use to get the new net book value. So I'll get my 250 and add it there. Does that make sense for you? Do you now get it? Esther, do you get how we do the accumulated depreciation? Okay, so what is the carrying amount for motor vehicles is going to be 480 minus 255, which should be also 255. Then we shall move on to plant and equipment. To be the same story, we'll get the cost of the plant and equipment. Thank you, Peace. Cost of plant and equipment, it cost us 2.1 million. So I'll come and write my 2.1 million. And I will also find the accumulated depreciation. So I'm just going to go again back to my notes and go to my plant and equipment. I know we have accumulated depreciation brought forward, which was 720, and we have the depreciation charge for the year. So I'm going to get my accumulated depreciation carried forward, 996. I'm going to carry that and put it in my accumulated depreciation for the plant and equipment. The net book value for that will be 2.1 minus 996. 996 minus 2.1, it should be able to give us 1.1 as its carrying amount. And so we'll add 8.2 plus 225 plus 1.1 to be able to get our net book value, which is 9.5 million. So that will be it for the non-current assets. We'll go forward for the current assets. We will now move on to the current assets. Organize in order of liquidity, remember, so let me know how we start. What do we start with first? We'll start with inventory. I'll start with inventory. Our inventory is where it's our closing inventory. Remember, I told you, settlement of financial position keeps closing balances. So how much was our closing inventory? 2.4. Just to confirm that, I can confirm that by going back again to the P&L and seeing what I used as my closing inventory. My closing stock was indeed 2.4. So it should be the same here. 2.4 millions. And then next, in order of liquidity, we have trade receivables. That should be the next item, I believe, should be trade receivables, which is 1.3. We don't have any notes to do with allowances and whatnot. So we are just going to take the 1.3 as it is. We'll add our 1.3 there, our trade receivables. And then next, what do we have as our current assets? When we look through, we have taken care of inventory. These are expenses, accumulated profits, this is equity. We have taken care of the receivables, this is expenses, revenue, capital, buildings. What else haven't we taken care of? Did we have cases of prepayments? And yes, I think we did. Marketing paid in advance. We had a prepayment of 18 million. So I'm also going to come and add my prepayment of 18 million prepaid expenses, which are marketing and advertising of 18 million. And then thereafter, what else do we have? Do we have any cash? We have bank of 225. I do not seem to see bank, so I'm looking for it. Okay, it's here, 150. We have bank of 150. You said we have bank of, oh, it's okay. We have bank of 150. So we're going to add our bank of 150.
Abi, nzigiraako ku gundi eyo.
Okay, so please make sure you mute yourselves. Please make sure you mute yourselves. When we get inventory and add up 2.4 plus 1.3 plus 18 million plus 150 million, how much should that give us? And I just make my rough calculation here. How much should that give us? How much is that? $3 million. Okay, let me copy that. 3,802,000. Okay. Okay, thank you, please. So our total assets will be, our non-current assets plus our current assets. When we add up 9.5 million plus 3.8 million, how much do we get? How much is that going to be? Okay, let's see who has given us 14,446. Let me just confirm here with my calculator. It's 13,461. Yes, thank you. 13,461,000. Okay, so our total assets will be 13,461,000. So we move on to our capital and liabilities. Go back to the question and see how much capital was introduced. How much capital did we have? 4.5 million. So I'm going to get my capital introduced, add it there. That's straightforward. We don't have any adjustments for now. We had profit, accumulated profit brought forward, which was 840. We're going to add it to our capital. The accumulated profit that we had brought forward, which is 840. We add it. And then, of course, we also have our retained earnings that we got from our P&L, which were how much was the profit? 4 million. That's 4,791,000. I'm also going to add it there. My retained earnings for the year. This should be what affects this should be what affects our capital and liabilities. Is there anything else that you think affects the equity when we look at the question? Is there anything else that you think affects the equity? Let's see if we have any drawings that should affect the equity, but I'm not seeing any drawings. Sajusa is a good businessman. He doesn't pick money from the business. So when we add that up, how much are we going to get? When we add up 4.5 plus 840 and 4.7, how much is that going to be? How much is the total capital and liabilities? Those of us with calculators. Okay, thank you, Peace. 10.1 million. I just confirm here with my own calculator. Hopefully we get, yes, we all have the same answer. 10.1 million. Thank you, Esther. So our total capital is going to be 10,131,000. So we move on to our non-current liabilities. This time around in the question, we have a loan. So we know at least we have a non-current liability, we have a long-term liability. 5% loan, which is 1.8 million. We're going to come and show that we have that loan in our statement, in our books of accounts. Our 5% loan, which is worth 1.8 million. And then I think that should be
Richard, may I please ask a question?
Yes, please.
I'm seeing 5% loan. Does that mean that they've already calculated for us that 5%? Is it the 1.8 or we have to calculate?
No, we don't have to calculate. What this statement means is just basically a summary that says the loan was given to us at 5%. So the total amount given to us was 1.8. We could just try and see the 5%. If we get 5% of 1.8, it should ideally give us 90,000, which is the cost that you see here. This 90,000 loan interest paid. So they are different. We don't have to calculate anything about the 5% loan. Someone asked, okay, we got it. Thank you, Peace. Okay, so moving on. Are we clear on that, Esther? Was it Esther who asked?
Yes, it's clear.
Okay. Also the retained earnings, I think we're also good, so we can move on. All right. Faith, are we okay with the retained earnings? All right, let's go on. Let's go forward. So that should be it, I think, for the non-current liabilities. We then move to our current liabilities. Let's go back to our question and see who is demanding us as a business. What are our obligations? Again, we start from the top. Bank, what? Bank is debit, so that is an asset. If it was a credit, it would be an overdraft. A bank balance is usually a normal debit balance. Inventory, everything looks to be okay. Accumulated profit, purchases, loan interest paid, loan, we've already taken care of that. Revenue, this is income, trade payable, capital. Let's see what else. Trade payables. Trade payables are liabilities. So we're going to go back to our statement, our balance sheet and get our trade payables, which are 1.5 million. We go back to our question. What else? What else do we have? I think that is depreciation coming up next. That is not a liability. Inventory was valued at that. Marketing expense paid in advances was an asset. We have accruals. We have an accrued salary of 30 million. So we're going to get that accrual and show that it's a liability of 30 million. Accrued salaries. Call those accrued salaries. Okay, so how much are our current liabilities? For the total of the non-current liabilities, that will contribute to the answer, that is 1.8. So how much are our current liabilities? How much are our current liabilities? 1.53. Okay, thank you. To be 1.53. So we add up our total capital and liabilities, that is the 10 million plus the 1.8 plus the 1.53 to get our total capital and liabilities. How much is that going to be? How much is that going to be? 13,461,000. Okay, yes, correct. 13,461,000. So that will be it for our total capital and liabilities. So ideally, this report is supposed to balance. Let me just check. My capital and liability is 13.4. And my total assets are also 13.4. So I'm just going to do a correctness check. I'm going to subtract my assets minus liabilities. A healthy company or a healthy business is supposed to have its assets and liabilities being equal. Let me see if mine is healthy. Assets minus liabilities. It gives me a 0. So it means that I'm correct. My answers are correct. Do we have any question? Do you have any question? Is there anyone who is not sure about anything? Please feel free to ask.
Yes, please. Clarity on where we got the accumulated profit. I don't remember.
Oh, okay. The question showed us that we have accumulated profit as at 1st June being 840. So it was already included in the question. It was already included in the question and we just added it there. We added it to our capital and equity. Any other question? Okay, that will be it for tonight. Thank you so much.
No, excuse me.
Yes, please.
How have you treated the trade receivables?
Oh, the trade receivables. This question didn't have any adjustments with the trade receivables. They gave us our trade receivables, which are 1.34, and there was no extra note about the trade receivables. We don't see anything like allowances and whatnot. So we carried them straight. We copied and pasted exactly what was given us in the question. That hence the 1.34 here.
Also about the accumulated depreciation, I didn't get it well.
Okay, every time, I think why it's confusing you guys, every time a business makes extra money, okay? Like every time a business makes profit, the business is growing. Like even just in your day-to-day life, if you have your small business and you keep on making profit and you decide to not use that profit, but rather reinvest it or use it for something else, means that the business is growing. When you start up a business with 1 million and you make profit of maybe 200, and you decide to keep that 200, the next time someone asks you how much your business is worth, you will not say it's worth 1 million, but it will be worth 1.2. That is the extra 200. And even in the next year, if you make another extra 200, you will not, and you add it back to the business and you decide not to use it, you will say again your business has grown. How has it grown? You have added the extra 200. So now you have a business that's worth 1.4. So profit keeps on increasing the size of our business. And whenever we make profit, we take it, we have a reserve for it, which we call a retained earnings account. So every time profit increases, or every time you make profit as a company, that account, the retained earnings account, increases. So for this case, for this particular question, they told us that they had the profit brought forward. They showed it to us in the TB, and it was already given to us 840. So it was just a matter of us adding it back to the capital to show that the business had grown. So we had accumulated profit brought forward, and we are supposed to add it to the net profit that we eventually got for the year. So ideally, we're supposed to get the 840 plus the 471 to get our total retained earnings. So in the event that we were to make a T account for retained earnings, we would just debit and credit. So it would be, I'm not going to be able to draw the lines. So because it's a liability, so it's an equity account, it increases by crediting it. So it would open up on the, apologies for that. It would open up on the credit side. Our balance carried forward, sorry, our balance brought forward would be that 840 that is given us in the question, and then would have profit for the year. Okay, being the 4.7 million. So, sorry, I'm not using the approximate figure. I'm just using the approximate figures. When I talk about 4.7, I'm talking about this 4,791,000. So if this was a T account for retained earnings, if it was a T account for retained earnings, it would be like that. And so we'll balance it off, and that's how we'll get our total profit. Do we have any other question? Do you have any other question? All right, thank you so much for today. I am truly sorry that I was late. I know it has affected some of your schedules. I apologize for that. Thank you and have a good night.